And I'm doing a short continuation of our, for this week, of our series on trade management, particularly with dual time frame or multiple time frame momentum. This is the end of the day on Tuesday, and we had a significant down day today, but what was significant technically about it, all three indexes closed below the April 5th closing high, indicating that this is probably the completion of a correction. It should be. And if that's the case, eventually the S&P should continue to below the April 2nd low without taking out the April 18th high. So that's fairly significant. As far as immediate trade-wise, let me just go to the 60-minute data. And again, well, let me go back to the daily. What's significant also is that the daily 8 has reached oversold. If the trend is bearish as anticipated, it should get dual look back oversold before it makes a daily low. And dual look back oversold, well, it looks like it actually made that today with the fast line of the 13 just barely reaching oversold. So this is going to be green tomorrow. So that would indicate we should be within a couple of days of making a daily low. However, given the close below the April 5th closing high, is that any rally should be corrections within a higher time frame bear trend. But what's significant on the immediate short position is having the sharp decline with to a new low, is at this point there's no reason to have the stop, certainly no reason than further away from today's high. The stop in my position was just above this little, what I had labeled as a wave C high. Now that we've made this new low sharp decline, there's no reason to have the stop, even on both units, more than just above this swing low, which is just a little bit above the 50% retracement. And here's a key also, is the 100% alternate price projection of this advance. So the whole point being, if the trend is bearish, and if it's going to be sideways to down for another couple days, is it certainly shouldn't get above this swing low. So I've adjusted my stop to 26.5875. That's just about I gave it a little bit above here, and let me put a note in here so we have that in our notes. Oops, that's the wrong one. I want the ABC. Did I say 28? I meant 26.5875. Okay, so that's going to ensure at least a small profit, because it went short at 26.8250. So that's pretty nice. And if we continue lower, as anticipated, certainly within a couple days of being dual look back overbought, going to at least advance the stop in one unit very close to the market. Going to keep the other stop a little bit looser. But for the point is today in trade management is once the trend gets underway, then you identify, well, what should the market not do if it's going to continue to be bearish? Well, it shouldn't get much above the 50% retracement or the 100% alternate price projection of that advance, which happens to be both of those just a little bit below this swing low. So logically adjusting the stop, and we'll adjust the stop again if we get a day or two sideways to down. Again, I keep my stops pretty far from the market until we reach extremes, and then I start bringing them close to the market. So I'll update this again during the week. Well, it's Thursday after the close, and the short position that I took on Friday was stopped out today. It went short on Friday afternoon at 26.8250, and a sell stop was below this little swing low here. And then at the end of the day on Tuesday, I adjusted that stop to a little bit above this swing low, what I've got labeled here as a wave B low, and that was right around the 50 to 62% retracement as well. As of the decline, it would be just that one-day decline on Tuesday. So where do you adjust stops? Well, one question you always ask yourself is, what should the market not do if it's going to do what I think it's going to do? So if the higher time frame daily trend was bearish, as the daily momentum's indicated, and a probable corrective high on April 18th, is should continue lower without trading above this swing low, whether it's a wave one low or whatever it was at the time, is that typically that would be well into the overlap range and not typical of an impulsive trend down. So the stop was just a little bit above this swing low at 26.5875. The next day, on Wednesday, did make a slight new low, and as of the time of the close, which is right around where my the arrow is that you had made a new low. It had traded above this sort of swing high, but that was made, overnight in very narrow range, low volume. So I didn't adjust the stop because, once again, the daily momentums were bearish. I think the 8 had reached the oversold zone, but the 13 fast line had not. So the probabilities were that it would continue lower. And again, I don't want to get out of a trade early when I'm looking at it intentionally, or the assumption is there will be a several-day trend. So it was stopped out this morning, and it was stopped out at 26.5875. That's where the stop was, and from a short of 26.8250. So a fairly substantial gain. However, I know the question a lot of you are going to have is, well, man, you were all the way down here, as low as 26.1125 yesterday, Wednesday afternoon, and had made this new little swing low. Why didn't I just adjust the stop? Well, again, for the reasons I just mentioned. Some of you might look for shorter term trades, and maybe you would have adjusted it earlier than I did. I left it where it was because the assumption was the market would continue lower. If we go back to our daily, I've working under the assumption that this is an ABC corrective high, followed by the close below the April 5th closing low, and that this is not part of a bullish impulsive trend up. So now we have come up and we've made a bull reversal in the daily momentums as of the end of the day today. So it looks like we probably have completed a daily low at the 62% retracement. Let me go back to the intraday data. So if it's we've traded up in that range, this is probably not the case anymore. It's a possibility that this is an ABC, but we don't want to lose sight of the fact that if this was an ABC decline, more than likely this is still all part of a correction that'll eventually, when it's complete, might be more complex than an ABC. When it's complete, the bear trend will continue. So why do I say, even though looks like the decline here was a 3-section, an A, B, C, why do I say that the advance here is still all part of a corrective rally? Well, number one is we've made this close into this closing range. So it can't be a 1, 2, 3. It has to be something other than that. And more than likely, it would end up being either a complex correction, A, B, C, D, with a wave E at a slight new high, or we still could have, this could be a wave 1 down. So what we want to do at this time is ignore the wave counts and only keep in mind one thing, is that more than likely this is part of a correction, and even if it makes a new high, it's just a more complex correction than a simple ABC. And right now, with the momentums are bullish, so more than likely we got another 2 to 3 days sideways to up. And typically, I would not trade that on the upside, given that the idea is this is all part of a correction and the bear trend will resume when the correction is complete. But if you're a shorter term trader, definitely with dual time frame momentums bullish and not overbought, the orientation for the next couple 3 days probably before the daily momentums get overbought, would be on the long side, and to look for short-term setups for the long side. We'll continue this after the close on Friday. This is an update on our trade strategies tutorial series, and for the next couple of days I'm not looking to make a trade, at least in the ES, and for all the reasons given in our regular report, and that the daily momentum is bullish, but more than likely this is a corrective high. And let me go to the 240-minute data. Even though the daily momentums are bullish, I wouldn't consider a long trade, just because if we're making a corrective advance, as I anticipate, the upside should be relatively limited. So what I'm going to be looking for over the next couple days, and we do have this Fed announcement on Wednesday, so I usually wouldn't even initiate a trade within a day or two of a Fed announcement. But I will be looking for the 8 daily momentum to get overbought or make a bear reversal for a continuation of the bear trend. So again, it's not that I'm prejudiced towards the short side and only want to look at short trades, but that's what the technical position is indicating, that the higher time frame trend is bearish. So I'm looking for those ideal setups to consider a short trade. And it's bearish for all the reasons given in our regular report and talked about through this trade tutorials. And the gold, which I won't even bring that chart up right now. As we know from the regular report, it made a dual look back bullish reversal in the daily momentums. So it's probably going to be sideways up for a couple days, but because the weekly momentum made a bear reversal, excuse me, probably any upside is limited to a few days and as a corrective rally against the weekly bear trend, and that's also because it closed below that April swing low. So we'll revisit that eventually, but it has to get in a little better position where the weekly and daily momentums are in sync with each other, and we find a nice little correction, whatever, to be able to enter with acceptable capital exposure. So that's it for this week's tutorial series, and we'll pick it up sometime during next week. Take care.